Well, today we're going to be talking to a good friend of mine, Cooper Seeman, who is somebody who has had a very unique pathway into the private equity space. We're going to be talking about a little bit about his story and how Regimen Equity Partners is a fantastic place to see capital at work. Dive in with me today on Money Match. Hey, welcome back to Money Match. It's Ian Ardill, where we talk about your life goals and your money and making it work for you. We're going to be talking to Cooper. Welcome to the show.
Hi, thanks for having me and really appreciate it.
Cooper, you are a managing director with Regiment Equity Partners. It's been a fantastic opportunity to get to know you over the last number of years. And certainly it's a privilege to be connected with you on a personal level, but also on a professional level.
We've really appreciated the relationship that we built with you and your group, Ian, and so feelings mutual.
Coop, I'm wondering if you can take me back a little bit and tell me a little bit about yourself. What makes you kind of enjoy your day? Tell me like what kind of recreational activities you're into. Tell me a little bit about your who is Cooper?
Yeah, sure. And West Coast, we're based in Vancouver, so, typical West Coast lifestyle, fairly active, snowboarding, running, biking, getting out into the outdoors. Also avid music appreciator, so, very interested in going to rock shows and electronic shows, and we even have a music industry business in our portfolio. So yeah, I don't know. In a nutshell, that's what keeps me busy outside of Regimen. But most of my time spent on, building Regimen and helping our investors get some great returns.
And it's uh, one of the things that I think makes you very unique is you come from a bean counting background. Like I say that in a humorous way, but oftentimes people think of the accounting industry as boring.
Yeah.
And you're not boring. But what I will tell you is that I think you have a measured approach to whatever you're doing. And I'm wondering if you can take me back to what made you get into accounting.
Sure. Yeah. Well, let me go way back. So, when I was growing up, my parents were actually very community minded, and we were into farming, and so I grew up on a farm for a big chunk of my life till 15. Learned a lot about hard work, but it's a very community minded environment, and so that was really instilled in me through my parents, who both passed now. And you know what I I really liked math through high school. Got interested in accounting, and so I love business, and so like that math and investing really appealed to me. Fast forward to I went through the typical CPA course with KPMG. And then I like to say I got my RA, which is my recovering accountancy. So I'm trying to get a personality back after being surrounded by accountants. And
I've never heard that one. I got my RA. That's a new one for me. I love it.
yeah, and so anyway, so look, fast forward through all of that, always really interested in investing. Even at my time with the accounting group, worked for a family office that was very focused on investing in hotels, different classes of real estate. Got involved with co-location facilities, which you now call data centers. And then when I left that, I was doing some tax-driven strategies, and then when I was off on my own, I was like, look, I want to meld the my passion for investing with investing in something that I believe in, but also going back to my childhood, really, I wanted to build community. And so, really, Regimen, in many ways, is just that. When I looked across the spectrum of where can you invest, real estate was not looking appealing. This, we started about 11 years ago. Real estate was not appealing. It's probably even less appealing today. Public markets seemed priced for perfection, and I think it's gotten pricier. And where I saw a lot of opportunity was with businesses of a certain size. We were looking when we started at 3 to 6 million of earnings, and we just felt that we could take these owner-led businesses, professionalize them, and bring together people that believed in what we believe in. All my partners have different stories, but they all align at the end of the day, and really put our money where we're interested in, and we think we can generate returns. But at the same time, we can do more with other people. We're very relationship focused, and so building that community is what Regimen is. It's a small community, and we take care of everybody's money like a community, and we want everybody to do well, and we in turn will do as well. So that's sort of the incentive.
Yeah, I want to drill into that idea of community. I've never heard you describe it that way, by the way, and I think it's very powerful. Um, like, I think when you really think about community, it's about having that community thrive and have success holistically. Would you say that would be fair? And like, so going back to your roots in a farming community, like, you want the whole farming community to work together in a cohesive manner to thrive and to work successfully. Um, my background, Coop, is I think you know this. I used to be a pastor, right? And you know, wanting that community to thrive. I actually find that a lot of my skills from my theological days and the days of looking after a church actually translate very, very well into the financial services industry. Um, Ultimately, I'm not propositioning or trying to push forward a religious agenda, but I'm certainly trying to care for people in a stewardship way, look after their wealth, look after their resources, and you're wanting to see the community as a whole succeed. It's deeply written into my DNA, and what I hear you saying is that's really part of your core driver is wanting to see that community succeed.
Absolutely. I mean, investing isn't a zero sum gain. It's not always I win, you lose. I mean, we can win together. And so, that's a big part of how we think. There's a couple of aspects that I touch on. One is that, we really, when we think about our investors, there's a pact that we enter into, and that pact is we got to do everything we can to return that money with a good return, right? And so we think about that all the time. And unfortunately, not everybody in the investing community necessarily has that outlook on when people give them money, but we take that very, very seriously. And I think it shows, and I think the people that we've attracted care about that and like that about us. We're also investing in operating businesses across Canada, and we specialize in taking owner managed companies, and over decades, which is a little different. Like, we don't think that there's quick fixes necessarily that don't upset the community that is built around the company and the employees, and the charities that the company sponsors. Like, there's a whole ecosystem around the company. And the conventional private equity funds might hold for 5 years. We think 15, 20 years is a much better holding period for a whole bunch of reasons. But it also respects the community of the company. You don't have to make quick fixes. You can really understand things before you start to try to improve the company and transition from being an owner managed company to a professionally managed company. And you have to think about the suppliers, you have to think about the customers of the business, the employees, the community that it's in, the executives. And so we're very relationship focused, and we're very much mindful that a lot of the times the reason why we're interested in investing in a company that's been around for 30 years or sometimes 100 years is because of that community that that company has built. That's why it's attractive to us. And so we need to be mindful of that and respectful of that. It doesn't mean that we have to, like, we can't make change. Like, we're there to make change, but if we do it in a respectful way that respects legacy, respects community around the company, it's just a more holistic way to, take that company to, in its next chapter, right?
Uh, uh, like this is gold, Coop. Like, Cooper, like this is gold in the sense of, there's a right way and a wrong way to do private equity, in my opinion. Like there's really two things that we see in the marketplace. You see, they go in, try to do quick fixes, or they go in to strip mine it, like literally blow apart a company, and they don't care about how many dead bodies they leave in their wake. And I don't mean literally, but like going in and terminating all of the staff. What I hear you saying is that the right way to do it is to go in, partner with an ethical, strong, long-standing business, and make micro changes and measured changes and shifts to really set that company up for the next layer of success, and the impact holistically, and the profitability actually can be quite strong. Is that kind of, did I encapsulate that well?
Look, I wouldn't describe it as right versus wrong. There's what we believe in, and then there's what other people believe in. There's some great other private equity groups that do fantastic returns. Uh, but sometimes when you take that pact, there's some hard choices that need to be made, and that can result in some of the things that you're talking about when things don't go swimmingly. We try to take a tack that doesn't go to there unless we've kind of exhausted all of our other channels, I guess. Like, we try not to go there. We don't generally embark in strategies that carry a lot of risk on that front. It's a much more slow and steady, tortoise wins the race kind of attitude versus quick fixes because we have to sell the company in 5 years. That's where we differ. I don't like to put a value judgment on it. We just think it's the right way for us
Okay.
and for the investors that are attracted to us and for the entrepreneurs that have entrusted us with their companies. We think that's the right approach for the community that we're a part of.
Last comment here, just as a something that I think is worthy of noting. When you talk about community, I think what was one of the things that you're highlighting here is that you're talking about all stakeholders in that community, right? And I think, yeah, when you think about stakeholders in a community, yes, there's the investor, but there's the employees, there's the legacy owners that may or may not still own shares. There's the, you mentioned something that's beautiful, like charity. Like, at our deal group, we give money to charities. It would be break my heart if we got taken over and all of a sudden that kind of got disrupted. I never thought about that. So like there's a whole kind of list of stakeholders that participate in your ecosystem. And and it's a beautiful thing that what I hear you sharing with us. So thanks, Coop. I'm wondering if we can switch gears a little bit and get into a little bit more of the minutia on Regimen itself, because Regimen, I think, is unique in the marketplace. We did talk about community, I think, a lot, but I think structurally it's also unique. I'm wondering maybe perhaps you can explain the structure. What is Regimen? In a maybe a little bit longer than an elevator ride, but in a short encapsulation, what is Regimen Equity Partners?
Sure. So, we're what we call a long hold private equity fund. So we're buying majority stakes in operating businesses across Canada. When I say long hold, that's used to distinguish us from the traditional private equity groups, which they might own a business for 5 to 7 years, whereas we're going in thinking about businesses that we want to be owners on for decades. So that's one difference. But there's a lot of other differences that we have. I've learned over my career that incentives of managers drives behavior. And what we've done is we've really, unlike some other groups, we're compensated differently. And, without getting into the minutia, we're much more focused on the returns that we generate on the fund, and we are not fee focused. Like my partners and I earn a salary. We don't earn a fee based on the amount of capital that we've raised. And what that does is it really focuses us on only raising capital when we need it for investment objectives, which I think is the right way to go because I've over, my 30 years career, I've seen people that have, built great businesses and then a lot of people want to give them a lot of money. And when you're earning a fee on the money that you've been given, the incentive is to take everything that is offered to you, even if you don't think you can maintain investment standards or deploy as successfully as what got you there. And we remove that incentive from our structure as much as we possibly can. And I think that has helped us maintain discipline and allow us to focus on really sticking to our knitting, not getting something that we call big-funditis, which is, you get all this capital and suddenly you start buying larger and larger companies because you got to put more and more money out. But that requires a different skill set and it's riskier
I
and you pay
love
more. And we're trying to avoid the incentives for us to go there.
I love that statement, funditis. I never, I love that because in my industry, we call it big case-itis, right? Like,
Mm.
oh, I'm chasing a whale. I'm chasing like, no, like, listen, you should be treating all of your clients, like that you're chasing after on an equal playing field. And if you're so laser focused on the big case, then you lose your fundamentals. You lose your the company ethos. And what I hear you saying is if you stick to your knitting and just really focus in on doing an excellent job with the capital that you're managing today, um, when you do need capital for new opportunities, it'll be there. And certainly that's been the case. My biggest problem, my issue with you, Cooper, is that when I want to place capital with you, you're like, I'm sorry, and we're closed. We're not taking on new capital.
What fund manager does that? It's like no fund managers generally don't do that. But when I say that, we say that because it's the right thing for our existing investors, and it might not be for prospective investors. And so we just say to people, hey, we just wait a little bit. There'll be an opportunity, but we will always prioritize the right thing for our existing investors over new people coming in. We try to balance it, right? But we do say that from time to time. We don't like saying it because we'd actually like to have more investment opportunities on our side of things, but we think it's the right thing to do for existing investors. And when I've been witness or heard about other fund managers that they just maybe didn't have enough investment opportunities in the space they've been, so they suddenly change their investment thesis. And that's okay. You got to evolve your investment thesis, but sometimes it's because, hey, we have all this money. Where are we going to put it?
Yeah,
Go into a different investment thesis, and the existing investors didn't buy into that new thesis.
yeah, and I want to drill into that because I mean I think you're touching on something that's absolutely fundamental. Is if you have a whole bunch of capital in the door, there's a pressure to get that deployed. Fair, and so because money sitting in the bank is very expensive for everybody. And so like you want to make sure that it's getting deployed. And so talk to me a little bit about the rigor that you go through or your team goes through in terms of why you would be excited about an investment opportunity or not. Because I think it's the measures in which you look at, I think is very different, or I would say more rigorous than perhaps some of your counterparts. And again, I'm not trying to wish ill on anybody else, but I'd love to drill into your methodology of why you pick up certain assets or don't.
Sure. Look, it's an exhaustive list. We tend to look at 150, maybe 200 opportunities that fit our space a year. Uh, we'll maybe do one company a year. Sometimes we don't do. Like the last year, we didn't close the deal. We tried, but we just didn't get there. But that's okay. Some of the best investment decisions I've ever made are avoiding train wrecks. And so that is part of the investing space. I'd say the number one thing that we
I just want you to say that one more time. The best investment decision I ever made was saying no.
at 100%. I mean, you've seen The Big Short, the movie.
Yep.
So when I was working at the family office, Goldman Sachs was pitching the family on one of those collateralized debt obligation. It's sort of a yield instrument. Is very complicated to understand. And I basically said, look, they asked me to look at it, and I said, I don't understand what this is, and I don't understand what the investment bet that we're making is. So I think we should stay away from it. And then, you have the book, you have the movie, you see what was really going on. And I feel like that's one of the best investment decisions that I've ever been part of in my career, right?
Wow.
So
I,
staying away from difficult businesses, ones that are hard. We've had our share of difficult businesses, and it takes up so much energy, and it's not a positive thing. You spend a lot of time trying to get your money back, right? Like four times the amount of work. Where as if you make the right decision, you find the right company, everything's really easy and very positive. So that's part of it. Other things that we look at, Ian, our partners, like who we're partnering, is probably our number one thing that we're looking at. We would take great partners with a good company versus a great company with mediocre or bad partners. So these are the executives and the founders that we continue to work with. And then, you can talk about industry, you can talk about size. We have to feel that the price is right. We have to feel like it's attractive. It doesn't mean that, we need to get the best deal in the world, but we just have to feel like it's the right value. It's not overdone for us. We need to see growth opportunities. We need to feel that technology won't displace the company completely. Look, the list goes on and on, what we look at.
one of the things that I think is interesting is when you buy out a company, typically you're not looking to buy, all the shares. You want controlling shares, but meaning that you can make the final say. But who do you typically want to have more skin in the game? So in theory, let's say you buy 55% of a company, who's got the other 45?
It's 100% is always executives working in the business or a founder who is potentially retiring, and we want to have an ongoing relationship with the founder, maybe for up to 5 years, just to help transition relationships over to the business, maybe be wise counsel for the business. So sometimes they roll some of their equity. But other than that, we do not have external partners necessarily. Sometimes we have co-investment, which is one of our investors in our fund comes alongside into that business. So we don't consider that to be outside money. But we would never have a business where somebody owns the part of the equity and aren't somehow contributing to the success of that business.
Yeah. So what I hear you saying, it really is the partnership, and like essentially the people who have the other shares, essentially they got skin in the game. They really do want to see success in that individual sleeve. So today, Regimen, how many sleeves do you have as of today?
So we have seven portfolio companies. I would say in all of those but one, the executives running the business have equity in the business, usually in a meaningful way relative to their own net worth. And then the one company that doesn't, that's because we've been doing a transition in that business and we're currently putting that in place. So that'll probably change in the next 4 months.
Um, kind of give me a nutshell, like, and again, just for listeners who may be interested in a regimen in the future, when your shares come available, give me some nutshell kind of targets. When, there's really two ways to get involved in regimen. There's a way in which somebody can participate in a preferred security. So it's protected by the quote unquote equity or the common shares. And it's driving out right now a fixed 8.5%. Fair?
Yep, that's right.
And then on the other side of the sleeve or the other side of the coin, there's these common shares. Describe for me, I know there's a couple of different classes based on, the the amount that somebody is deploying, but let's just pretend for a moment that they're putting in 50K or 100K, so they're in the kind of that base level expectation. Describe for me what might be a historical representation, but also kind of what your targeted return would be over the next 5+ years. What could a prospective investor hope for as a reasonable return?
Sure. We're shoot like let me start with the targeted return. So, from a targeted return point of view, we're typically shooting for 12 and up. 12 to 15 might be where we're shooting for. About 3% of that will be distributions that get paid twice a year. The balance will be appreciation in the units. We've been doing quite a lot better than that. So if you go back into some of the units that we issued, say, 10 years ago or 5 years ago, like I think our 5 year returns are high teens. It depends what class that you're in. We're really thrilled to have generated that for investors, but I just want to temper people's expectations. We'd love to keep doing that for the next 5 or 10 years. We're trying to do that, but I wouldn't want people's expectations going in that we'll continue to do that. And then a
So
lot of our
what you're telling me is
return.
past performance is a guarantee for future performance. No, no.
Exactly.
Yeah,
I'm not allowed to say that. I
yeah,
did
yeah.
not say
Past
that.
performance is not an indicator of future performance, but okay, I understand the target. Yeah. Okay, sorry.
Yeah, and then as part of that return, in because that appreciation on the commons, it doesn't get taxed every year, right? So we've got investors that came in, say, at $1, and the units are now, it depends what class it is, but you know, 325 a unit, and that represents tax-free compounding. Now, eventually, you pay tax when you withdraw out of the fund, but the longer you stay in, the more return is generated, and so you're really just continuing to compound as much as possible. That's what I wanted to do with my money, same with my partners. And so, again, we want our investors to share that as well. when you mention the preferred and the common, that that's one of the other differences about Regimen is that we split the equity box, the investment box, into two components. You've described them well. There's no upside on the preferreds, but there is a lot of yield. And so people can pick and choose what percentage they like, which is, by design and to give investors more flexibility to meet their own investing needs.
Coop, I'll end this with this question. Why Regimen? Like, why should a client, or a current client or a prospective client, invest with Regimen?
Well, when I look at that and to answer that question, I would say I would always focus on the people first and their values. And I think that our values are in the right place, and how we treat investors' money is who you want to put your money with, especially when you're with private securities like we are. That to me is one of the most important things in private investing. I think we check the box, but for the people that we do check the box, then it's look, it's uncorrelated return to a lot of other asset classes. The growth is not capped on our companies. We can continue to grow. I think that the baseline returns of what we're investing in is very attractive. And, I think that a lot of the other asset classes out there, private securities, public securities, they're just not as attractive to me today. They haven't been for a long time. And so, sometimes to get into private equity, it's hard to find an entree. Most private equity is focused towards big pension funds, large institutions. We're a high net worth family office focused fund. And so we think it's a good entree to get some diversification for people, with people that care about giving you your money back when you're supposed to get your money back and when you want it back.
Cooper, on behalf of my entire team, my clients, and as an investor as well, thank you. Thank you for partnering with us, and thank you for joining us today on Money Match.
Really appreciate it, Ian. Love being partnered with your group. It's been a fantastic relationship.
Thank you, sir.